It's almost 1 p.m. in Sydney, 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks extending a global rally with cooler US inflation, reinforcing bets on Fed cuts. They might come as early as September. Major equity benchmarks setting records worldwide as Treasury yields retreat. More big China tech earnings on the way. We're going to preview JD.com and Baidu's results amid signs of pressure on profits. And we're going to get the latest travel trends from MasterCard and their new report on an industry that's breaking boundaries. All right, we've got some live pictures here. We're looking at Beijing. It's going to be a welcome ceremony for Russian President Vladimir Putin. He did arrive in China in the very early hours of this morning. So he's on his way there to Beijing, where he will meet Chinese President Xi Jinping. This is an extension of their no limits relationship that they signed back in 2022. And that happened, of course, just before Russia launched its invasion of Ukraine. This is going to be the 40th time that Xi and Putin have met since Xi Jinping first came to power. So we're just awaiting the Russian leader's arrival there. Beijing looking very nice ahead of his arrival, where those talks will take place with the Chinese Premier or President Xi Jinping. So we'll have more on those pictures as soon as something actually happens, but Putin is on his way to that welcome ceremony. Okay, in the meantime, let's take a look at how markets are faring. A lot of green on the screen today. Avril Hong, what are you watching?
That's right, Paul. This is the post-US CPI everything rally, whether you're talking about stocks, bonds, currencies, commodities, all gaining ground amid those expectations that we will see Fed rate cuts as soon as September. We are hearing some of the Fed speakers don't sound terribly convinced, though, so that's worth noting. Even one Mizuho economist says that this fixation on inflation out of the U.S. Seems to be prompting an overreaction to the US CPI print. Still, we're seeing that green. Australia is leading the charge as well. We had some jobless data and a surge on the jobless rate that's prompting expectations of a rate cut there. Even the yen is climbing, and that is despite Japan's GDP contracting more than expected. Let's flip the board because I want to take you to some of the movers in Hong Kong as well, as we're back from a holiday and traders getting their first chance to react to some of these Chinese tech earnings. Tencent beat on earnings, and we actually saw that lift for its sales coming through from the TikTok-style services. But it was a different story for Alibaba. It was a miss, and it was dragged by investments. So you're seeing here the divergence in profits reflected in the stock performance. But the big story coming out of China is how those reports show that authorities might actually be mulling a plan for local governments to actually get these unsold homes from distressed developers. So we're seeing the gauge of property developers in Hong Kong surging about 11%, and that is to the highest since December, Paul.
All right, thanks very much, Avril. Let's take you back now to Beijing. Xi Jinping has just made an appearance as he awaits the arrival of the Russian President Vladimir Putin. Putin did touch down in Beijing in the very early hours of this morning, so this welcome ceremony about to take place. China, of course, has been a very important partner for Russia since Russia's invasion of Ukraine. It's really helped Russia weather all these US and European sanctions that followed that invasion. But it's a tricky balance for Xi Jinping to strike here because, of course, it still needs access to US markets. It needs an ally in Russia. So a bit of a balancing act for Xi Jinping as we await the arrival of Vladimir Putin there for that welcoming ceremony. All right, let's take a closer look at the meantime. The latest US CPI report that, of course, really moving markets today. The headline figure rising slightly less than was expected in April. Core CPI, which excludes food and energy, cooled for the first time in 6 months. And it also snapped a streak of 3 above forecast readings. Economists say the softer data boosts the chances of a Fed rate cut later on this year.
Inflation it's taking its sweet time coming down, but we still think it's a downward trend.
The big picture on a core basis
is that the rate of inflation has come down a lot.
Really great set of data, I think, for the Fed, especially on the inflation front.
This, to me, is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do two. And I think data like this, if it persists, I think that'll give him that opening.
I don't think July, but I do think September is possible.
We need to see more weakening in the data, especially on shelter inflation, for the Fed to begin to gain confidence and get comfortable in terms of beginning to ease rates.
The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
Yes. All right, our next guest says US disinflation is still sufficient to allow for a September rate cut. Let's bring in Stefan Hofer, Chief Investment Strategist at LGT Private Banking Asia. Stefan, thanks so much for joining us. Let's get straight to the chances of a rate cut. We do have a chart here that illustrates the market's now looking at 2 rate cuts this year. What's your view? And if you agree with this, when do you think the first move might be?
Yeah, so first of all, in terms of the numbers themselves, it's really not so much about the actual print, but the fact that for the first time in what feels like a very long time, it was a little bit better than expected. So that's why you get all this sort of celebratory analysis that we've just heard from many other guests. For us, we think that September would make the most sense. You would have this further flight path, which is a gentle disinflation taking place, and that will open the door for a September cut. Again, it's not really about the numbers themselves, but really about this expectations change that happened, which is why markets are in such a good mood today.
Stefan, just as you're speaking there, I want to alert our viewers to what they're seeing on screen there. That is, of course, the Russian President Vladimir Putin arriving in Beijing. There he is with the Chinese President Xi Jinping greeting various other dignitaries. So the Russian president going to have some talks with Xi. He'll be visiting a few other areas, including Harbin, while he's in China as well. So that welcome ceremony just taking place at the moment. We'll bring you more on that story, but let's get back to our guest Stefan Hofer now. Just in terms of what you were saying around expectations for rate cuts, inflation as well, I have another chart to show also that shows supercore inflation did in fact tick up a little bit in that quarter, 4.9%. Do we need to be a bit mindful here also that even though we had an encouraging read, that the fight against inflation might not be over yet? We have had a few false dawns before.
That's right, but we can also look at the data from a different perspective, which is, for example, breaking it into services versus goods. And services side a little bit more sticky, but goods inflation, so for example, this notorious used cars component, which skyrocketed during the pandemic, that's actually falling quite sharply. So the good side of things is certainly better than services, but the overall blend, yes, I think you're right. You know, we need to continue to watch this closely, but all in all, September we think still makes sense for that first cut.
All right, let's talk a little bit about the market impact of that. It certainly was profound. We've seen rallies everywhere. US indexes at a record, and the joy has spread to Asia today as well, with most indexes in the green. And we've also seen the US dollar having its biggest one-day drop this year. Do you think this is the start of a trend? And if so, which emerging markets might best stand to benefit?
I'm not so sure we can sort of declare that it's sort of a trend, but actually it's the yen out of all the currencies in the Asia-Pac region that really we have to focus on. The yen at, even at 154, even at 150, we think is far too cheap and represents a major challenge for the Bank of Japan and the Ministry of Finance on the ground in Tokyo. Imported inflation in Japan for food is extremely high, so getting that yen stronger one way or the other is the only real way that households in Japan can sort of get some relief given what's happened with the major depreciation of the yen that we've seen so far this year.
Well, an easy way to get yen strength would be for the BOJ to continue tightening. But in the light of that rather woeful GDP read that we had today, a 2% contraction on year for the quarter, we've got the BOJ really on the horns of a dilemma here. What's the path ahead?
Exactly. So it is an exceptionally difficult challenge. We can say that for Japan, it's a tougher road ahead than even, say, the ECB or the Fed. But bear in mind, though, that potential GDP growth in Japan is very, very low because demographics and other structural factors. So you're always at a run rate of maybe 0.5, maybe a little bit higher. So any given quarter, Japan can easily slip into recession. It's not so much about the GDP story. It's really more about, can the BOJ be brave enough to move forward and tighten monetary conditions so that the yen appreciates? This is really what has to happen here.
All right, Stefan Hofer of LGT Private Banking Asia, thank you so much for joining us with your insights today. Let's take you back to Beijing for the meantime, and there you see two best friends, Russian President Vladimir Putin and Chinese President Xi Jinping, attending that welcome ceremony, inspecting the troops there. So Vladimir Putin, this is the 40th time that he's met his Chinese counterpart since Xi Jinping took power. He's going to be there for a few days. Among other talks, he's going to be visiting the northeastern city of Harbin as well, where he's going to be taking part in the opening ceremony of the 8th Russian-Chinese Expo. So this no limits friendship continuing to deepen. Let's bring in our chief North Asia correspondent, Stephen Engel, now for more context. So, Steve, give us a sense of the importance of this visit for both leaders.
Well, it's definitely important for Vladimir Putin. You said it correctly. They've met more than 40 times since Xi Jinping took power in 2012, 2013. And they've been meeting more frequently, obviously, in light of or in the face of the sanctions, obviously, against Russia for its war in Ukraine, and increased pressure from Washington against Beijing to not supply it with dual-use technologies that could end up on the battlefield. And that is one issue that perhaps these two gentlemen will be talking about, because it's no surprise as well that he's also bringing along his new defense chief. I'm talking about Vladimir Putin, who is an economist by trade. He's also bringing his central bank governor along. So there's a lots of speculation that perhaps they're going to try and find ways around, avoiding the potential U.S. sanctions, secondary sanctions on Chinese banks, because we all know that the Russian trade relies on China. Two-way trade, I think it was a record $240 billion in 2023, more than double that of 2020 of $108 billion. So Vladimir Putin and the Russian economy right now absolutely needs China, and China feeling a bit diplomatically isolated as well in the crosshairs of Washington's pressure, is shoring up that support between these two gentlemen. So, I mean, there's lots to talk about. There's potentially securing a new deal for the Power of Siberia pipeline. They'll probably be talking about the viability of the Power of Siberia 2 proposed pipeline that would go through Mongolia. And again, issues surrounding trade finance and through the banks.
Steve, it's an interesting point you make about Vladimir Putin bringing his new defense chief, the central bank governor, as well. But there's some risks here for Xi Jinping as well, right? I mean, if these two countries figure out a way to circumvent U.S. sanctions, there's just a risk that sanctions noose could get tighter.
Yeah, that's right. And, I was there in Beijing when Antony Blinken, the U.S. Secretary of State, gave a press conference, and he said to us gathered there at the U.S. Embassy that they reminded Beijing again that the potential of sanctions against Chinese banks is real. If there is evidence found that the state-owned banks in China are helping facilitate the trade of so-called dual-use technologies. Also, of course, semiconductors, ball bearings, which are very necessary in an industrial base, but also in a mechanized war, and also other dual-use technologies that have found their ways onto the battlefield. So again, that's why I think there's going to be a lot of discussions in his trip to Beijing about potentially using smaller Chinese banks that are not necessarily tied as closely to the U.S. financial system as the state-owned banks, because we did see in data, I mentioned that Moscow trade with China reaching $240 billion in 2023, but in the last couple of months, Bloomberg data is essentially showing, especially in April, we saw Chinese exports to Russia were down 13% year over year, the second month in a row on of an annual decrease. And Russian media is essentially reporting, Paul, that Chinese banks in late March began blocking payments from companies in Russia buying components for electronic assembly. So again, the two sides could be having serious financial dialogue about how to bypass that, so they are not sanctioned.
All right, Chief North Asia correspondent Stephen Engel there. As we see pictures of that welcoming ceremony for the Russian President Vladimir Putin, he's going to be in China for 2 days, where he'll have talks, of course, with Xi Jinping and also a visit to the region of Harbin. All right, still to come, analysis on Chinese tech giants ahead. Morningstar Investment Management Asia is going to be joining us, and we'll discuss why they're expecting strong earnings from JD.com later on today. This is Bloomberg. Okay, let's take you back to Beijing. There you see the presidents of China and Russia side by side as that welcoming ceremony appears to be wrapping up. President Vladimir Putin arrived in Beijing very, very early this morning. He's there for a 2-day visit. The two countries looking to continue to deepen ties, as we heard from Stephen Engel a little bit earlier there as well. Russia's defense chief and central bank governor also there. We are expecting that some discussion may be taking place on ways that Russia may be able to find workarounds to some of those sanctions that have been imposed on it by Western nations. There may be some risks involved there for China as well. As part of this 2-day visit, though, the Russian president will also be visiting the region of Harbin. Okay, so the two leaders heading inside now. Okay, let's get to some other geopolitical news of the day. And Singapore's got a new prime minister. It's fourth, Lawrence Wong, warning of a riskier and more violent world as he officially takes the helm of the city-state. Wong says that Singapore should brace for new realities as great powers compete to shape a new global order. He says Singapore will continue to engage with both the US, its largest foreign investor, and also China, its biggest trading partner.
As a small country, we cannot escape these powerful cross-currents. As an open economy, our livelihoods will be hit when multilateralism fractures. As a diverse society, we will be vulnerable to external influences that tug us in different directions. We must brace ourselves to these new realities and adapt to a messier, riskier, and more violent world.
All right, for more on the city-state's new leader, let's bring in Bloomberg opinion columnist Karishma Vaswani in Singapore. So, Karishma, Lawrence Wong talking of a messier, riskier, more violent world. What struck you about the speech?
I mean, everything that he pointed out in terms of the fact that it's a far more dangerous environment as he takes on this extremely important role, becoming only the fourth prime minister in Singapore at a time of real upheaval around the world. And I think it is worth pointing out, Paul, and I've written about this before in my opinion columns, of course, where we are in an environment that in many ways has mirrored the beginnings of when Singapore first started, when Lee Kuan Yew had to oversee that rather tumultuous period of Singapore's separation from Malaysia, independent, trying to carve out a sort of niche in the world as an independent nation. At that time, Singapore depended on things like globalization, free trade, in order for this tiny island to go, as it is famously said, and as Lee Kuan Yew has written about in his book as well, going from third world to first. But this time round, Singapore can't depend on those friendly forces of globalization anymore. It's a far more fractured global environment, and that is precisely what Lawrence Wong is telegraphing as he takes on this role to try and ensure the survival of this nation.
Well, in his speech, Wong also pledged to create a just and more equal society. Let's have a listen.
Younger Singaporeans in particular have spoken clearly. They want a refreshed Singapore dream, one that is not defined by material success alone, but also offers meaning and purpose in their careers and their lives. I am determined to help Singaporeans realize your dreams. We will foster a fairer, more just, and more equal society.
Well, a lot of our viewers might be familiar with the so-called 5 C's in Singapore. What are they? Cash, credit, club, car, and condo, right? Okay, so it's
yes,
fairly wealth-focused. But
you've got that right.
Is that going to be the story going forward?
No, not at all. And certainly when you hear what Lawrence Wong said, it chimes in with a lot of Singaporeans, you know, across the spectrum who are saying that it's time for a different kind of Singapore dream. Singapore went and has sort of, you know, grown on the back of this idea of that it needs to survive in this very difficult environment. But now it is one of the richest countries in the world. There is a very good standard of living here economically. But what people are craving for is a different way of life, I think it is fair to say. And you heard that from what the Prime Minister was talking about in his speech, moving from, as you point out, the 5 C's to perhaps the 3 C's, I should say, where it's about cooperation and in particular compassion. Lawrence Wong has talked about the compassion deficit in Singapore in the past, and that is something that he seems very keen to address. Now, my suggestion to him as he takes on this new role and get settled in would be to not just listen to members of his own cabinet, but also to seek out alternative views, because as tiny as Singapore is, it is changing and there are different norms that are at play here. It would be worth listening to some of those people, perhaps in the opposition as well, and inculcating those alternative views as he moves this country forward into the new era.
All right, Bloomberg opinion columnist Karishma Vaswani there in Singapore. Other top geopolitical stories that we're tracking. The US says it's accelerating arms supplies to Ukraine as the country's military confronts a Russian assault in the northeast. Russian troops are pushing deeper into the Kharkiv region, taking control of some villages close to the border. The offensive is stretching Ukraine's forces and may push Kyiv to redeploy units from the front line in the east. The US has warned Israel that it risks creating a power vacuum in Gaza, urging the country's leaders to focus more on post-war planning. Israel's gradual deployment of troops into Rafah appears to be the start of a full-blown invasion into the southern Gaza city. Secretary of State Antony Blinken says the US is worried about the blocking of aid for the Palestinian territory. All right, we have plenty more to come. Stay with us. This is Bloomberg. Let's bring you a tale of 2 tech stocks now. We're looking at Alibaba there, losing a bit of ground in Hong Kong, off by about 3%. And this is after fourth quarter profitability, a bit weaker than expected. Tencent, on the other hand, look at that go, 4.25%. Had a pretty good quarter there as well, better than expected earnings. And we are waiting to hear from Baidu and JD.com after the close today. Elsewhere, we've got China property stocks doing pretty well as well. Look at Shema, up by 28.3%, and the broader index in Shanghai doing pretty well also. More to come. This is Bloomberg. Welcome back. You're seeing live pictures there of Shanghai. China markets just heading to lunch. It's a pretty good day, though. We've got most markets around the region in positive territory. The CSI there better by 0.75%. Let's check in now on how markets are doing with Avril Hong in Singapore. And Avril, this rally's looking pretty broad-based.
Yeah, it is an almost everything rally, and it's that fuel from the US CPI print, but on the mainland, they're getting that added lift on expectations of policy support for the property sector, and the gauge of developers in Hong Kong jumping about 11%. That is the highest level since December. We're also keeping an eye on tech. The earnings have been pretty mixed so far, but we're going to see how the rest of the Tech 8 perform later today. Let's flip the board and take take a look as well on the Japan GDP numbers because they contracted more than expected for the first quarter. And this is as consumers and companies cut back on spending. Our economists flag that might be a temporary factor at play here as well. Industrial production reduced as an automaker was forced to idle output given the safety scandals. Despite that, we are seeing a tempered expectation of a BOJ rate hike, and the yen still climbing. It's still that story about higher US yields. Let's go across assets and take a look at what else is happening in Japan. I think we're seeing those bonds climbing, stocks also running higher. If we can just flip the board and take a look at what we're seeing on the stock market, the Nikkei is still in the green, but you can see how the banks are still coming under pressure. It is that BOJ narrative, despite the forecast of record profits. Automakers also down today on the stronger yen, Paul.
All right, thanks very much for that, Averill. As you mentioned there, tech stocks joining in on this everything rally, with one exception. We'll get to that in a minute, but we are keeping an eye on shares of Baidu and JD.com ahead of their earnings releases. Bloomberg Intelligence believes Baidu may post slower first quarter advertising growth. And that is amid intensifying competition from various short video platforms. Meanwhile, JD.com expected to report better margins on a greater utilisation of its logistics assets. And our next guest primarily researches China internet and logistics stocks, and she's ranked top 5 for JD.com and Alibaba, according to Bloomberg data. Let's bring in Chelsea Tam, Senior Equity Analyst of Morningstar Investment Management Asia. And Chelsea, I want to start with your expectations around JD.com. Is there a risk here perhaps to costs? I mean, it's brought in a few new policies recently. It's widened its free delivery service. It's got a new free return service as well. What sort of impact might that have?
Yeah, I think you're right that there will be some pressure on costs. So this year we're expecting that the net profit on non-GAAP basis, I don't think that it can rise much. In fact, it's possible that it will decline. So I think this year margin in the non-GAAP net profit line would definitely see pressure because JD has to retain customers, and I believe that probably 40% of the GMV actually comes from very, very loyal customers at JD, and then these people are what JD.com want to retain with a free, a lower shipping threshold.
Of course, JD.com, along with a lot of these other e-commerce names, very reliant on the health of the Chinese consumer. I mean, how is that looking to you at the moment?
Yeah, absolutely. So I think that you can see that there is a bit of pickup in consumption in the discretionary side. According to Alibaba, they said there is some green shoots, but then I don't think that the trend is very certain yet. I believe that if anything is going to be slow, because I don't think that just like some property measures release will immediately boost the confidence of consumers.
Well, we've got shares in JD.com only up about 16% this quarter. I mean, it sounds pretty good, but it does lag some of its peers. Do you have an outlook for the stock price?
For JD.com, well, we have a long-term investment horizon. So I think that JD.com is still a cheap stock to own. So I think in the long term, we're still quite bullish on the companies because I think that it's coming off from a sort of tough year last year with restructuring going on, and the coming quarter, the first quarter, will be the first quarter where that you will see normalized growth, excluding all the restructuring efforts. So yeah, I think we remain buyers for JD.com.
Mm-hmm. You say you've got a longer-term look at these stocks, and I know you've got a target of fair value, $96 on Alibaba, for example, but we're seeing it reversing away from that today. The fourth quarter profitability, as I mentioned a bit earlier, coming in a bit weaker than expected. How long is it going to take for Alibaba to hit that target that you've got?
Well, actually, Alibaba is fairly valued right now. So then the reason is that we are encouraged by the double-digit GMV growth and the outlook that take rate will increase. But we really want to see these together with stabilized margin. But I think it will take a while. So if we see that, and then we see improvement in consumption sentiment, especially in the discretionary side, where Alibaba is stronger at, then I think that we can see the share price to rise towards our fair value of 96.
Well, Bloomberg's put together a chart which shows Alibaba revenue growth compared to some of its peers. It's 6% in the first quarter. I mean, it's pretty good, but it's still trailing some of its competitors. But what's more important in this environment, in your view? Is it revenue growth or is it the fight for market share?
For Alibaba, right? So for Alibaba, honestly, I think it's important for companies this day to do three things, like a steady revenue growth, and then margin cannot decline so much, and a lot of return back to the shareholders. So I think the investors are quite demanding these days. Market share is, I think, important, but it depends on how you achieve it. If you just achieve by giving out subsidies, it's not sustainable. But if you achieve by lowering the trouble for consumers to consume, for example, easier delivery to the door, things like that, then I think, and also offering competitively priced products, these are the winning recipes. So I think we need to achieve market share through that. And then with market share, and then you can have better mind share, and then you can retain users, then I think take rate will come naturally. So I think these are the ways how I think e-commerce companies should work on.
Chelsea, I just quickly want to get your views on Tencent as well. It's having a pretty good day in Hong Kong at the moment, up by about 4.2% right now. What is your outlook for the coming quarters for Tencent? Can it sustain this momentum?
Yeah, I'm sorry. So there's another analyst that covers that gaming and media segments.
Oh, I beg your pardon. All right, Chelsea, we'll have to leave it there. But Chelsea Tam of Morningstar Investment Management Asia, thank you so much for joining us. Now, you can follow more on this story and all the day's trading on our Markets Live blog. And that is on the Bloomberg at MLiveGo, M-L-I-V-Go. And you can get a market rundown there in one click. Commentary also and analysis from Bloomberg's expert editors. And you can find out what's affecting your investments right now. Welcome back to Bloomberg Markets Asia. You're watching the India Focus. Let's check in on India's pre-market session. A global funds budding rotation to battered Chinese stocks from India might be set to stall. And that's as investors turn their focus back to China's fundamental problems. For more on this, let's bring in our Asia Equities senior reporter, Abhishek Vishnoi. So, Abhishek, tell us more about why that rotation trade is fading.
Well, the net sentiment on China remains positive, but there are a few things, from long-term allocation perspective. First is earnings. Earnings were improving at the margin, but that case is crumbling again. You can see what Tencent and Alibaba have delivered in terms of growth, in terms of outlook for the economy. Nothing impressive. Earning estimates for China are trickling lower. Earnings estimates for India are going upwards. On valuation, that was the prime argument for some rotation that started from India to China. The valuation premium that India commands has narrowed. And if you look at the overall picture on economy and triggers, India is commanding the world's fastest growing major economy. And China is mending its economy. And in terms of triggers, India is set to have another cycle, possibly under Modi, right? And China is actually facing a US election cycle where rhetoric against Chinese items and products is only going to widen. So, this setup actually, from long-term allocation perspective, what our reporting is showing is that at these levels, that risk reward is not there. And that's why this trade stalls. Don't get me wrong. I mean, these are both markets to own. But, there is one market, China, which is a value market. And there is India, which is a bet on growth.
So what would this mean for China's ongoing rebound?
Yeah, so, like I was saying, I mean, China has become a market. China's role in portfolio has essentially changed. Prior to 2019, it used to be a bet on growth, but the growth is not coming. Valuations are really cheap, so it has started commanding this role of value, this role of income in portfolios. So from that perspective, and from the perspective of increasing southbound flows, the rally would widen. But U.S. elections are on the horizon. We have seen a lot of rally. Some of the things have turned oversold. So this would get checked if earnings fail to deliver. And so far, first quarter season has not been great. So what would turn this tide, in wake of a US and a European Union going against China, going more protectionist? That's very hard to imagine. So in that context, there would be some check of optimism, even as the risk remains on the upside.
All right, Asia Equities reporter Avishek Vishnoy there. Thanks for joining us. Let's take a quick look at some stories that are making headlines in India. The trade deficit widened to a 4-month high in April as strong domestic demand bumped up the nation's import bill. Trade Ministry figures show the gap between exports and imports stood at more than $19 billion, topping forecasts. Imports rose on higher inbound shipments of gold, petroleum products and electronics. Bloomberg has learned that Bharti Enterprises is planning to sell its stake in a real estate joint venture with Brookfield to a listed property trust backed by the Canadian investment giant. Sources say the deal may value Bharti's stake in the venture at around $750 million. Brookfield India Real Estate Trust is also set to pay for the stake by issuing new units to Bharti. All right, we're just a few seconds away from the open in India now. One would anticipate that we see the rally extending to Indian markets as well, of course, off the back of that CPI print that we had out of the US a little bit earlier. That came in a bit softer than anticipated. On the quarterly read, at least anyway. There are some signs that core inflation remains sticky, but it was enough to spark pretty much an everything rally across the Asia-Pacific. And if we take a look at futures for the India pre-market there, we're seeing them in positive territory as well. One particular side issue that could throw a wrench into the works is the ongoing India election. We're up to round 4 of 7 at the moment. Signs are that voter turnout, perhaps not everything that the incumbent was hoping that it might be, might cause some foreign funds to stay away. But here we go, India opening for trade now, and as perhaps we expected, seeing a pretty reasonable bounce to the upside there. The benchmark Sensex up by about 0.4% in the first few seconds. The Nifty and the Nifty 100 also showing similar gains. A little bit of softness there for the dollar versus the rupee, but the dollar's down against most currencies at the moment. All right, do stay with us. We've got more on markets in just a moment. This is Bloomberg. All right, a look at some of the top corporate stories now. Bloomberg has learned that HSBC is leaning towards appointing its next CEO from a shortlist of internal candidates. According to sources, the lender sees CFO Georges Elhedry and Wealth and Personal Banking head Nuno Matos as leading replacements for Noel Quinn. We're told HSBC has engaged an external recruitment firm to benchmark them against external candidates for the role. Some shareholders in BHP and Anglo American expect the takeover saga to continue. I've told Bloomberg there's room for a sweetened third offer by BHP before a regulatory deadline, and that is on the 22nd of May. Anglo's rejected both of BHP's previous all-share approaches so far and announced a revamp that includes exiting diamonds, platinum and coal. Sounds familiar? Paramount is said to have had discussions with Amazon about expanding ties between their media businesses. Paramount has been struggling with falling ad sales and money-losing streaming business and is fielding takeover offers from independent producer David Allison as well as Apollo Global Management. And Singapore Airlines said to be rewarding staff with a bonus payout worth almost 8 months of salary, and that's after the carrier delivered a second consecutive record annual profit, which was 24% higher than the previous year. The airline says near-term demand for flights remains healthy, citing robust appetite for travel and a buoyant cargo sector. Right, the global travel sector is breaking boundaries in 2024. This is according to MasterCard Economics Institute. Consumer spending on tourism remains robust. Passenger traffic is soaring as well. Their annual travel trends report shows Japan welcomed a record-breaking 3 million plus international arrivals in March. And while outbound travel from China recovers, we have more Indians now traveling than at any time in history. So for more on how this is impacting some of the region's largest economies, we're joined now by David Mann, Chief Asia-Pacific Economist at MasterCard. David, thanks so much for joining us. I want to start off in Japan, topping the trending list. It is, of course, a notoriously expensive destination, unless, of course, the yen's really weak, which it has been for a while. So how much of that responsibility can you park at the door of a weak yen, and can Japan retain its top spot?
Well, first, Paul, thanks very much for having me back on. It's great to be here today to get a chance to talk about the travel report. Certainly your point about the relatively weak yen, and it's not just relatively weak, it's very weak against almost any other major currency that we look at. That is a big factor in helping to drive up the strength of the inbound tourism into Japan over the last year and more. And I think actually because the yen is, even after the moves in the last couple of days, gone a bit stronger compared to where it has been over the last few years, that very attractive exchange rate does actually make Japan a relatively cheaper option, more attractive destination, particularly for those travelers where the exchange rate has moved even more in their favor. So, for example, from, say, Singapore, from the United States, there's a major gain that can be had from going there. The other big thing that I would note is that of all the big travelers' destinations around the world, of course, it is all about the experiences. But in the case of somewhere like Japan, we're actually seeing not just the strength of travelers coming in for the experiences, say for fine dining, but also they're heading to the shops too when it is a relatively cheap destination, as it has now become, which is quite different to the broader trend of global travel, which has been much more biased towards experiences spending over the usual retail therapy that had been available all the way through the pandemic period.
So when we're talking about experiences, and your report does note that experience spending does trump material purchases, what sorts of experiences are travellers looking for?
Well, of the big ones, of course, ones that we've looked into quite a bit has been various concert events. For example, the Taylor Swift concerts in Singapore saw a major spike in the amount of cross-border tourism and therefore expenditure. The experiences of, say, going, whether it be skiing or, say, going dining, and that has been a very big part of the experiences spending numbers when we look into the details. And of course, going somewhere like Japan, so famous for being so good on the cuisine front, and in addition, say, a nice cooler destination to cool off, say, if you're in somewhere that's as tropical as, say, Singapore is, that's really been making the big difference, especially when the price is right alongside that. The other thing, though, that we've been noting is that compared to 2019, there's been an extended duration of the average trip by around 1 day extra worldwide, and it's been slightly more gains in the average duration of trip in the places where the prices of those destinations have not risen as much compared to the places where they've risen a lot more. A differential where it has not risen that much has been a gain of 2 days, therefore even more potential for more spending as people spend longer traveling, compared to the more expensive destinations where they've raised prices a lot more. They have not gained as much, but everyone, even the ones who've raised prices, have seen that impact of travelers staying for a bit longer.
Mm-hmm. In terms of extending trips, how much of that do you think is a function of the fact that not all air ticket prices are quite back to where they were pre-pandemic?
There certainly is a role for that too, that certainly people have prioritized travel. It is expensive, therefore once you're there, make the most of it. There could be some element of hybrid work maybe playing a role in this as well, but I think that's absolutely the right way of thinking about it, that we've seen this increase that could be of making the most of those trips. There has been this accumulation of excess savings that is being used up, we think, by a lot of these travelers, and we think actually the affluent consumers have been much more dominant on average. Probably the spending power of folks who are on the airplanes flying out for international trips today is probably higher than it would have been if we go back to the pre-pandemic era. In certain places, like say Australia, we've seen a big difference between the affluent consumers spending on travel versus the mass market consumers. Most likely in locations such as Australia, it comes down to a lot more of the domestic trips being an attractive alternative when the cross-continental trips in particular are relatively expensive.
I want to talk about some of these country-specific findings that you had, Nara, particularly in terms of Chinese tourists. I mean, demand is recovering. Where are we at in terms of domestic Chinese tourism and outbound Chinese tourism?
Well, the domestic tourism story actually picked up and fully recovered as of about a year ago, so very quickly after the reopening in the post-COVID restriction era. The international side is still about 20% below the sorts of passenger volume levels that we were at in 2019. We think we will get there most likely by the end of this year. It has been a little bit slower, but in the meantime, while we're waiting for that, and we think that will eventually take place to happen, what we've also seen has been a major pickup in the other very populous consumer market in this region and indeed globally, which is India, where we actually are seeing more Indians traveling in general than we've seen any time in history. The sort of run rate we've seen in 2024 so far has actually seen more travelers than you would have seen for a full year only 10 years ago. And we know that with the growth of the middle class there, 20 million more we think will be added to the population of middle class in India over the next 5 years, and 2 million more to the affluent consumers there. That demand side is very strong, and we think is only going to be a long-term story where we might be comparing India to China as the most dominant outbound tourism spenders in this region or even globally at some point.
All right, David, unfortunately we're out of time, but thanks so much for joining us, David Mann of MasterCard there. Just before we leave you, let's take a look at how markets are tracking at the moment. We'll take a look at the yield on the 10-year. That's slipping down to, where are we, 4.3129 at the moment. We take a look at futures for the US session. Looks like that everything rally still got some legs in it because here in Asia we're seeing pretty much every stock, every sector, every index in positive territory. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa up next.